Super Jim Leaviss from MG Investments, and here is a 3-minute video about the Japanese economy and bond markets. So let's start with the Japanese economy. Potential growth here is really very low, perhaps 0 to 0.3%, thanks to the falling working age population. That should mean that we start seeing some stresses in the labour market, because growth is going to be really quite strong for Japan in 2017, thanks to a big fiscal stimulus that's coming through. So growth might be over 1% next year. Now the labour market here is already very tight. We see unemployment at 3%, even lower than the US, which is just under 5%. But unlike the US, here the participation rate, and especially the female participation rate, has been rising quite steadily. We've not seen an impact yet on wages, and that's despite some very strong shortages in the construction industry and in the care industry. Japan's not an economy that welcomes immigration, so they haven't been able to deal with the problems that way. So perhaps in 2017 we start seeing some early signs of wage pressures. We're not seeing them yet. We have collective wage round negotiations called the Shunto coming up in spring next year, but generally those wage negotiations are quite backward looking at last year's inflation rate, which was still quite low. So there's no real hope that next year's the year that wages pop and deliver a boost to incomes in Japan, but perhaps 2018, especially as we're going to see increases in the minimum wage from a measly 820 yen per hour to 1,000 yen per hour.
Here we go!
And what about the Bank of Japan? Well, they've moved from a zero interest rate policy to a negative interest rate policy, with rates now at minus 0.1% in common with Europe, many areas of Europe. They've also extended their QQE program, the buying of JGBs, but most interestingly, they've started pinning the level of the 10-year JGB to zero. They won't allow it to rise any further than that. This is something that we've not seen for a very long time. The Fed did it in the 40s and 50s, and they worried a lot about what would happen when they exited that strategy. And I think that concern is also prevalent now within the investment community in Japan. You know, if interest rates do go up here, and I think the next move will be higher rates in Japan, because negative rates have proven to be quite damaging to confidence in the banking sector. So if rates start to rise, presumably the 10-year yield will also have to be adjusted higher in terms of its target, and you know, we could see some quite nasty impacts on the JGB market. But being short of JGBs has always been known as the widowmaker trade, and perhaps this time will be no different.
Here we go!
Now the final couple of things I've been thinking about here in Japan. The yen, it looks really cheap actually right now. We've had 20% less inflation in Japan than the United States over the past decade. On a purchasing power parity measure, or a kind of Big Mac index, we shouldn't be trading at 115 to the dollar, but more like 90. So perhaps a cheap opportunity to buy the yen at the moment. The second thing that people talk about here a lot is obviously the debt dynamics of Japan. We've seen debt to GDP now well over 200%. And there's talk about rating agencies' downgrades over the next couple of years down to BBB level, and people worry about the impact that might have on people being forced sellers in their portfolios. So another fascinating trip to Japan. Thanks for watching.